think you can learn a lot more about managers through some of the more challenging times, or how they were working through some of the deals that didn't quite go to plan to help salvage returns for investors. Did they communicate effectively through areas where they were having challenging times? And that to me really always sticks out.
Before he ever evaluated an alternative investment, Jake Heidkamp was evaluating collateralized debt obligations and bank evaluations in St. Paul, Minnesota. The kind of forensic financial work that teaches you how to read a balance sheet like a litigator reads a contract. Then Jake became a lawyer and eventually found his way to FactRight, one of the industry's leading independent due diligence firms. For more than a decade, Jake has helped RIAs, broker-dealers, and investment professionals evaluate private placements and so much more. He's reviewed thousands of offerings. He's seen what separates a great sponsor from the risky ones and understands the red flags that advisors can't afford to miss. Last week on Wealth Unfiltered, Andrew Beer told us the highest value question that an allocator can ask is, what am I actually buying? Today, we ask the natural follow-up question. When you're buying access to private real estate, what does a good sponsor really look like? And what are some of the red flags that you should be looking for? I'm Samantha Parinello, and this is Wealth Unfiltered. So I'd like to welcome to the show, Jake Heidkamp. Hi, Jake. How are you?
Not bad. Thanks for having me, Samantha.
Yeah, very, very excited to have you here. This episode, is part of a series where we're helping the modern allocator. And I think it's really exciting to have someone, especially a CEO from FactRight, on the show. So I'd love for you to give some of your background and then also explain what FactRight is and the reasons that RIAs are using them.
Yeah, for sure. So personally, my background is I was trained as a lawyer, member of the bar of the state of Minnesota. Also did an MBA at St. Thomas in Minnesota. Spent a little bit of time doing structured finance valuation and some financial institution mergers prior to joining FactRight back in 2015 with a focus on due diligence on public and private investment programs, predominantly in real estate as well as in private credit. So FactRight itself has been around for about 20 years. It was originally formed to provide consulting services for 1031 exchange programs for Ameriprise Financial. And from there, it grew to encompass due diligence for independent broker dealers. And I would say starting around 2017-ish, we started to see that the regulatory environment was getting a little bit constrained for independent broker dealers. There had been some significant consolidation and increasing compliance-oriented regulatory environment that was creating some strain on some of the smaller players in this space, much like what I had seen before in the community banking space, where smaller players just had to consolidate to survive. We started looking at where are avenues of growth for our audience, given that kind of our core skill set is providing investment research and due diligence on alternative investment products. We started to look at, the RIA space was really an area where we were seeing growth. We were seeing, new firms get started, breakaway firms from larger RIAs out there. And it was just an area that had much more activity in it than in the IBD channel. Now, obviously, we still have plenty of clients that are independent broker dealers that have thriving businesses, but we definitely saw where the puck was moving and really made a concerted effort starting around 2017, 2018 to really drive engagement with RIAs. And most notably, that's come through our RIA Focus Conference in March of each year down in Scottsdale, Arizona. We crested over 225 RIA firms that were attending at the last one. And it's kind of been just year over year growth across that landscape. And as we've interacted with more RIAs, we've developed kind of a measure of trust with them, where now we're getting a number of these groups are inviting us to make introductions with sponsors, both in private credit and real estate that they're looking to do business in, that, hey, we'd like FactRight to vet through this group before, our RIA is going to make an allocation in it. So it's been a very symbiotic relationship with a number of the RIAs that we've been able to build out some trust with.
Wonderful. And, with your forensic background from everything you've done, does it change how you read or how you evaluate a private offering, whether it's debt or if it's private real estate?
Mhm. Yeah, I would say we kind of operate from a framework of trust but verify, where we'll take statements that are made to us at face value, but we really want to see some documentation behind it so that we can validate what we're seeing there. I would say there's kind of an inherent to be successful in the due diligence space. I think there needs to be a measure of kind of an inherent skepticism and, hey, okay, you're making these fantastic claims to me about prior performance or about the deal flow that you were getting. It's like, show me some actual evidence that supports some of that. And I mean, frankly, it sounds rather cynical, but generally, if everyone did exactly what they said they would do, I probably would FactRight wouldn't really have the kind of the role that we have within the industry. So we like to operate from that kind of mentality, trust but verify, show us the evidence, and also to kind of work towards a ball and strikes mentality. We're here to provide an objective document that is calling out the facts of an investment program while also providing a layer of reasonable analysis onto that investment program, or if it's the sponsoring entity, onto their kind of prior performance track record, their financial performance, et cetera. We're here to really provide a foundational level for an RIA or a broker dealer to continue their diligence and research. Really, just here's kind of a baseline from which you can build upon.
Absolutely. So will you walk us through what a typical fact rate framework looks like for when a sponsor comes to you with an offering and there's a process, for the final report to happen? Can you kind of walk us through that?
Yeah, absolutely. So at FactRight, we have two primary due diligence work product suites. One would be sponsor operational due diligence, where we're kind of doing the deep dive into the people, processes, personnel of the sponsoring entity itself. That would include a prior performance track record, getting a sense of how the investment and asset management processes work, who's responsible for what kind of policies are in place that the manager has written down, what kind of policies are in place that are more informal, whether or not there's any policies related to the governance of affiliated transactions and key considerations when conflicts of interest may be in play. Also, we're going to be touching on the financial performance of the sponsor itself. So think the entity that owns the general partners of a number of private funds. How is that business performed over time? How has it grown? What are the key trends that we're looking at right there? Also, given that many of those sponsor organizations may be a little bit smaller, they may not all have audited financials, there can be some really deciphering through some unique line items in there as well. And really what we're trying to get a grasp of is, does the sponsor have a sustainable business at present? Is it reliant on outside capital to continue its operations? And what are the critical factors driving that growth? Is it reliant on more, annualized fee revenue? Is it more episodic transactional fee revenue? Just really getting a sense of how that sponsor is working. Then obviously also looking through what has been their performance track record over since inception. Oftentimes we're working with a number of new groups in the market that are kind of just emerging into the syndication space. And in those senses, you may have principals that have prior performance track records that may not be attributable to their own name, maybe from previous experience that they had. So kind of deciphering out and providing color on the experience that individuals have, while not necessarily allowing that to be, passed as their prior performance track record as well. One of the biggest challenges I would say in that space has been, I would say, a lack of homogeneous data across return profiles. I mean, there's a number of different metrics that we're looking at. One would be, DPI distributions on paid investments, TVPI total value on paid investments, as well as, IRR calculations, multiples of invested capital. Oftentimes, the data sets that we're seeing are not congruous from one manager to another. So there's a little bit of data cleanup that's also required here. I think it's frankly one of the areas that our industry and some of the trade associations, we're really hoping that we can kind of get on the same page as far as more consolidated and more homogeneous presentation across different asset classes. I think it would really benefit everyone to kind of see a more apples to apples comparison across the board. That's one side of what we do, which is the sponsor operational due diligence. The other side would be fund level due diligence. So this would be taking a deep dive through the offering and organizational documents, whether they're a PPM or an operating agreement or a limited partnership agreement or a prospectus if it's a publicly registered filing, really getting a sense of what are the structural components of the investment that the RIA or broker dealer's clients are going to be investing in. What's financial performance of that fund, any current portfolio dynamics, and really also looking from kind of a first principles stop on what exactly are the investor rights, what are the governance provisions of the fund, how is it structured in terms of the manager making its carried interest, and really trying to understand how investors are aligned with management or how they are not. I mean, we were looking through 300 plus funds a year, and it's not always the case that, things are end up the way we'd like to see them. And that's one of the things that I would say FactRight really excels at is, especially on the first time that we're working through with a new investment manager that's looking to syndicate out deals, is we see a lot of deal flow. So we have a pretty good understanding of what marketable provisions are within the syndication space. And it's really working through with sponsors. Hey, you might want to adjust this kind of preferred return, or you may want to bolster up this affiliated transactions policy or create some other, more investor friendly provisions within the fund so that you're competitive within the marketplace and that you're really showing that alignment with investors that we'd like to see. So those are part of the things that we do on a first time engagement. Generally, this process, assuming that we're getting all the documents that we're requesting from a manager, is going to be somewhere around 4 to 6 weeks on the front end for a fund report, generally 6 to 8 weeks for the sponsor operational due diligence report. We need to, digest through a lot of those documents that are being furnished to us, and additionally set up a series of interviews with management or the portfolio managers to really get a sense of kind of how things are being conducted and follow up on any questions we have. There's always going to be follow-up document requests as we're working through it. And really, it's much more important, we find, to get this process done right the first time, especially with emerging managers, than, necessarily just being focused specifically on, let's produce a research report as quickly as we can. We want to make sure that we're providing sponsors with, a holistic experience and that we're giving them a chance to really put their best foot forward. And frankly, many of them, will go back to the drawing board and restructure parts of their investment funds to be more palatable based on some of the recommendations that we have. So that's a pretty long-winded answer as to what we do as far as FactRight in the process. But
No, I appreciate it. I think it's great for our listeners to get the full understanding of what it is that you do, especially for the process. When you talk about, the sponsor due diligence, what separates a sponsor that clears diligence from one that doesn't?
I would say the biggest things, while we didn't touch on a couple of the areas, oftentimes where we run into, I would say, issues with managers is in the legal and regulatory history. And this is not anywhere near as common as you would think, but oftentimes with emerging managers, there may be some litigation history related to past events or with individuals. And that's really one of the key screens that we're running for our clients. They're very much reliant on that legal and regulatory review that we're doing, docket searches, all sorts of background checks as well related to key principles and individuals at managers that, maybe in somebody's background where it's not going to be palatable for the securities world. And we take that, very seriously. We also will discuss these matters with sponsors and what our concerns are, if anything is coming up that way. I would say other areas that can be a little bit of red flag territory are oftentimes you'll see some managers coming into the space with, they have consolidation of previous programs and they're looking to distribute those to a new investor base. And we really want to get a sense and understand how valuations are being conducted when you have some of those conflicts of interest in there. And there are definitely some best practices that we've seen. Oftentimes we're looking for investor consent on the consolidation from the previous funds that the sponsor managed. Oftentimes that's going to be through some sort of an UPREIT transaction or a series of 721 exchanges into a new fund. Similarly, we also want to see third-party pricing support related to the values at which investors came in. This oftentimes is going to be within real estate, an appraisal. Sometimes it'll be a broker opinion of value that may be in a little bit more limited scope. But generally, we want to see pricing support, and we want to see that previous investors consented to the transactions. Those things generally are, you'd say, really would help gain comfort in what a sponsor is doing on a go-forward basis. The other sides of it would be, what's the overall financial health of the sponsor? And oftentimes we'll see groups that, especially as they're starting out, their reliance on, financing from one or more key individuals related to it, and really want to get a sense of kind of that level of commitment and what the aggregate dollars are and kind of the game plan. It can be pretty expensive to break into the syndication space. And we really help, coach a number of these sponsors as to like what reasonable expectations are within the marketplace. And I think part of that, since 2022, when interest rates started increasing and we've seen equity capital on the real estate side, that capital raise has been diminished, that it really is, a long-term commitment that needs to be made from sponsors in this space. And it hasn't been the most buoyant market for new equity raising, specifically within real estate during that period of time. So I think it's also, guiding on what reasonable expectations are in the market as well.
Absolutely. Is there one common failure that you see more often than others?
I think we definitely see a number of groups that come in. They may have strategies that are substantially similar to other strategies in the space. So, I mean, like probably the biggest one that we've seen over the last number of years is there was a flood of managers that were working specifically within multifamily and targeting, the Southeast or Sunbelt, like this very, very large demographic trend that, people are aware about, but everyone was kind of competing in the same geographies and the same markets. And we've met a number of managers that, have historically been based in those areas. They've been working in those markets for decades, and this is kind of their backyard. They know what they're doing, and they've produced some strong results related to that. What I would say is we've seen groups that are kind of just maybe more tourists within those kinds of markets, where they understand that people see the data, that this is where things are going. They're going to want to go and develop and invest in there. And oftentimes, things don't quite go to plan. And we really want to see groups that really kind of stick to their knitting as far as when they're coming out in this space. So I always kind of like to tell sponsors that nichier is good, and that if you do have a kind of a vertical that you've been working in and you've developed excellence and operational excellence and you have a prior performance track record there, it may be a longer road to identify capital market participants that will want to get into that space, but at least you're kind of sticking to your identity within that. And obviously all these different asset classes go through various cycles, and eventually you're going to be able to line that up with groups that are looking to allocate capital. So, I mean, while everyone was always, looking at over the last decade, all the Southeast US and, Class A multifamily development, and that's all been fine and dandy. Obviously, we've come into some turbulence over the last couple of years. We're always looking for where are the managers that are looking at, secondary and tertiary markets that are not in the hot geography. How has that performed over that period of time? And frankly, I think managers that can effectively communicate, hey, we're not chasing kind of the shiny object that everyone else is looking at, but we're more interested in grinding out singles and doubles in areas that may otherwise be overlooked. Those are things that always pique our interest for sure.
When you all are evaluating an opportunity, once you're done, let's say you've completed the diligence, someone's passed, at that point, do you all either take a role in saying, oh, we believe in this deal at this point or in this sponsor, and kind of utilize your due diligence to help that sponsor? Or are you guys just like Switzerland, like once it's done, and you get a stamp and then you guys move on from there? What is that process like in the sponsor relationship?
Yeah, it's a great question. And generally, we are more like Switzerland in the sense that we produce the report. We'll notify all of our FactRight Report Center users that, hey, XYZ manager report is available on the FactRight Report Center, which is kind of our digital platform by which we distribute reports to broker-dealers, RIAs, family offices, and other authorized users. There aren't going to be any go, no-go recommendations in those reports. It's going to be just the facts layered with some reasonable analysis. That will include, as I mentioned, the legal and regulatory checks. Will also include site inspections from a network of commercial real estate brokers that we work with on identified asset deals, so that, there's boots on the ground that have looked through the real estate that is included within the investment program. We do also facilitate a couple of meetings a year with our audience, and we invite sponsors to participate on that. We will kind of reach out to about 2 dozen of the sponsors that we're working with, and we're working with over 100 different managers a year to present, what their offerings are to our audience in that space. And then we also have, approximately upwards of 100 managers that are going to be in the exhibit hall during those events. That's pretty much the interactivity that we foster. And I think most people could gather that, if we're inviting a sponsor to present on stage, that yes, we definitely find what they're doing to be, generally positive. Obviously, deal to deal, there may be some delta in there, but generally that we find those managers to provide some compelling opportunities to the our audience of RIAs and broker dealers.
Wonderful. And so for somebody listening who isn't an RIA but has an advisor and they're like, oh, wow, this is really interesting. Okay, FactRight does diligence on the sponsor. Is the average human investor allowed to go in and review this? What's the regulations there?
Yep, great question. And our reports are limited to home office personnel. So think like a chief investment officer or an executive of a broker dealer or an RIA. We have an author. There's a process to authorize access to our report center. So if they wanted to gain access, they go to factright.reportcenter.com, and then they could click request access. From there, we'll vet through that they are in fact working with home office or that they're licensed in the securities industry. And then we oftentimes that will include a follow-up call if we're not sure exactly who the person is on gaining access to the report center.
So if they're like, man, I really wish I understood whether or not the sponsor who I saw, was like available through an RIA, would they be able to request that information? So not see the report, but request the info from their registered advisor? Or what does that process look like for a client?
So, well, I think the best way to think through this is the reports are going to be very much restricted to like investment committee and investment decision maker personnel. We do restrict the access of that. Like once a firm downloads, a report on, XYZ fund, the terms of that usage agreement are that it's really just kept to the home office level and not shared with underlying reps, advisors, or the end investor. Now, what we are also building out right now is a FactRight testing center where we're providing educational materials and then a quiz for registered representatives and advisors of a financial firm. So this would be kind of that next layer of folks at a financial services firm that are working with alternative investments, that they can get a sense of, hey, I understand, a little bit beyond just the marketing materials that I've received from a sponsor related to XYZ fund, and the home office of the RIA or broker dealer can get a sense of, hey, our reps and advisors, understand a little bit more about this investment product after they've gone through this advisor training document and then taken a 20-question quiz related to the investment fund or an educational module related to a specific asset type or investment structure type. So think like a 1031 exchange or a 721 exchange or an interval fund or a qualified opportunity zone fund, that we're helping to facilitate education not only on individual investment funds, but also on investment structures as well, to really just provide a foundation of education for a number of wealth management firms in the space. We just launched that in the last 2 months on a new platform. We've been doing that work for a number of our clients for almost a decade, but we just kind of put it into a new system that is integrated into our report center right now.
That's fantastic. So for the sake of understanding your role within the offering, if somebody sees through their RA, they have the offering they're looking at has a FactRight due diligence report and they've passed the due diligence, it basically adds credibility to that fund. Is that the relationship dynamic?
Yeah, I would caveat that a little bit.
Okay.
As I mentioned, the report is designed to be kind of a balls and strikes type analysis of the fund. So it's really critical that if you're downloading a report, that you look through our material conclusion sections where we're going to identify specific strengths of the offering or the sponsor, as well as material risk factors related to it. I think there's a wide range of users that we have at FactRight. And I think what may be appropriate for the risk tolerances of one firm may not necessarily be appropriate for the risk tolerances of other firms that are looking to participate. And again, this all is designed for, a high level analysis of the investment fund or manager. And then, each individual firm is going to need to make further investor suitability analyses on particular clients that they have and whether or not they're appropriate for any individual fund. But I would say there are definitely some groups that we work with that are very conservative on what they're looking to include within their alternatives platform. Think some development deals may be a little bit outside of what they're looking to do. They may be, focused more on kind of current income and, some more preferred positions within a capital stack of a fund as opposed to kind of getting out there on the risk spectrum there.
So you mentioned, multifamily within alternatives. And obviously, alternative investments are becoming bigger and bigger, and people are allocating more to those. So, as somebody who is evaluating a fund, you guys see hundreds of funds come through your desk, and you guys are evaluating not only the sponsors but the funds themselves. So, I'd like to know from your point of view, what would be some green flags on investments that you've seen that really help move the ball forward for somebody who's evaluating a deal?
Oh, yeah, absolutely. I think part of it is when you look at, like, let's say one specific market that we have extensive coverage in, which would be the syndicated 1031 market. You have identified assets where you can do property level due diligence on those assets. So even from sponsor to sponsor, some of the offerings may be stronger than others, given that they have identified assets within the portfolio. That's an area that I think you can see a lot of good opportunity sets emerging because you have the ability to underwrite a specified asset, really get the story of that, understand the valuation dynamics, understand the market and submarket related to it, where I think that can be an area where we can help really provide a due diligence edge for groups that are looking to allocate in that space. I think part of that becomes a little bit more eroded when you're looking at larger evergreen funds in the space where you're kind of like, hey, we have this. Oftentimes we note within a prospectus where we'll laundry list out, the permitted types of investments that a fund has. And oftentimes, in a public registration document like the prospectus, that you may be looking at, 20 pages of listed out permitted investment types and derivatives in there. And so really what we're trying to do is connect with the portfolio management team, really get a sense of like, okay, you can do anything and everything under the sun within this fund. What are you actually looking to do? And oftentimes we're looking at some of those funds right when they're getting started. So, it may have a limited portfolio that just given some of the constraints on the size of investments and the diversification they'd like to achieve, that initial portfolio composition may evolve over time as additional capital raising is there. And that's one where we really, really try and dive deep and really get a sense and understanding from discussions with the portfolio management team. Where is this fund looking to go? What are the compelling opportunity sets? And that's definitely a significant area of focus for us is really the interactivity with the portfolio management teams to get a sense of direction on where they anticipate the fund moving.
One other thing I mentioned was that, you see so many deals. So as an average right now, is there something that you're seeing as an overall average for what makes a strong co-investment amount, fee structure, waterfall alignment, like those types of things like currently?
Yeah, I think it's going to depend a lot on the underlying investment strategy that's being employed. But a couple of big trends that I think we've seen over the years is one has been since rates started moving up in 2022, we started seeing more and more bridge or gap lending funds come into this space where they were providing some, short-term financing for real estate transactions, especially in light of, pending maturities for individual real estate projects. So this has been a very attractive, area within the market as far as risk reward. I mean, when you think about it, if you're underwriting new money loans into bridge lending after you've already taken a haircut as equity prices have come down on the underlying assets, and you're coming in at a 60 to 70% LTV on a, post-peak pricing for the underlying asset, that could be a pretty good spot to be in terms of like downside protection while also still making on the loans, some very, very attractive interest rates. One thing that I would note, though, is that this is where diligence really matters, is the fund structuring across the board has been kind of the Wild West. And as far as in terms of how investors are participating in those loans, whether or not they're, capturing an appropriate preferred return in our estimation, given that, a lot of these loans are going to be priced, 10 to 14% interest rates in the short term. Additionally, there's substantial fee income that's typically generated on the origination and servicing and, any sort of modification or extension of those loans. And oftentimes we'll see, funds where investors are participating, even though they're providing 90+% of the capital to the fund, that they're participating only up to a preferred return of maybe, half to 2/3 of what those interest rates are, not participating in the fees. So we always try and provide feedback with sponsors that, hey, we'd like to see greater alignment of interest, investors participating in, essentially all the fee streams that the manager is participating in so that there's not any, misaligned incentives there. That's one area that I think we've done a lot to work with a number of groups to really create some better practices in the market. And it still is very much a kind of a Wild West landscape there. The other area that I would note or major trend that we're seeing is larger institutional managers coming in specifically into the 40 Act space. So the tender offer and interval fund space. I mean, we've all seen the headlines related to BDCs and private credit funds. But we're starting to see an evolution into more asset classes that traditionally have not been available to retail investors, specifically venture capital and private equity. And part of this has been a shift in kind of the regulatory landscape with the rescission of the 15% rule from May of 2025, where the SEC is basically guiding that you don't need to be an accredited investor or a qualified client to invest in 40 Act funds that may have exposure to traditional 3C1 or 3C7 funds. So think hedge funds, private equity, venture capital funds that were historically limited to generally qualified purchasers. And now we're starting to see a new vintage of funds coming out that are giving non-accredited investors access to a bunch of those strategies as well. And there have been a couple of interval funds in the past that have provided some opportunities, specifically within venture in this that we've covered, but we're starting to see this is really starting to accelerate. So on one end, it's a new opportunity set, more choices for investors in there. On the other end, some of the structuring that we've seen from some of those deals leaves a little bit to be desired. And we're, working to try and push back and make some more investor friendly provisions on those. But overall, we do see quite a range of manager sophistication and experience within the deals that we're covering in FactRight. I kind of joke, we work with the largest institutional managers in the world in real estate and private credit, Apollo, Ares, Hines, Starwood, Blackstone, those kinds of groups, all the way down to, I jokingly call it, two guys in a truck or two guys in a Bloomberg that are putting together their first syndication outside of maybe some friends and family. And I think that's really the kind of hallmark of FactRight is our value in working with those emerging managers that are coming into the space and helping them, really put in place and think through the kinds of processes, policies, and procedures that they need to really compete in a regulated industry and really show that level of sophistication. I mean, it's one thing to have the investment acumen and the ability to execute there. That's obviously incredibly critical, but so much is also incumbent upon having the back office and the capabilities there to really achieve and deliver meaningful experience for your investors.
Absolutely. It's really nice to know that I didn't realize that like an emerging companies, that small was able to go into FactRight and you guys would spend the same, time doing the diligence process with them. That's really exciting, I think, for people who are trying to get out there and do this for the first time.
Oh yeah, we've definitely seen. We don't always get to the finish line with the number of those groups. I think plenty of them realize like, hey, I may need a little bit more seasoning, may need to build out some more structure, process, and improvement. But oftentimes, it's very inspiring seeing the level of zeal that a number of these principals have, and like that this is the next step for their firms, and they understand that working with a group like FactRight, we can help. While it may be a little bit longer process, we can help them, think about how to build out their businesses in a more effective way and really a constructive dialogue on that.
Let's say a sponsor comes to you, whether they're small, medium, or large, and they are doing the due diligence process with you, and you guys come to, I don't know if it's a standstill or you come to one of those red flags you mentioned, and they're like, okay, so we have this thing that is stopping us from moving forward with you. Is there a corrective action that can be taken where they can say, oh, okay, so like we're not doing this the right way. You've shown us what the right way looks like, and they can move forward? Or is this like a hard no and you guys push them off and it's just not the right fit?
I think it's going to depend a lot on what those material red flags that are coming up. Like if it's legal and regulatory, that's going to require some either resolution of something that's still pending, or if it's something that's already baked into the cake where it's been fully adjudicated. I mean, the thing is what it is, and people are going to draw the conclusions that they're going to draw from that. If it's also a financial matter, or that can be a little bit harder to solve if unless there's additional outside capital, or kind of a change in game plan and how the sponsor is going to navigate through the future, that can be kind of difficult. But if it's much more along the lines, and I would say it's very common for groups to, hey, we do these things, we don't have them codified in like formal policies, kind of working with us and in getting a sense of the questions that we're asking really can help them kind of take the next step. And like, okay, so you've described to us what your process is, formalize that into some process and procedures and internal policies, and also start working on, recording minutes related to your investment committee meetings or your board meetings. And oftentimes with a number of emerging managers, you may have management or ownership consolidated in one or two or three individuals. And oftentimes that lack of formality, in without a doubt, these groups are having these discussions. They may not, be recording some of those minutes, which we would like to see. And we definitely do see to some extent with more sophisticated and larger scale enterprises. So I think it's part of it is getting a sense from those managers, like, here's how you can, start graduating up the level of sponsor sophistication, which will definitely benefit you in the long run, especially once you start having conversations with larger RIAs or other capital markets participants as well.
Absolutely. And you mentioned, questions that you all ask and getting familiar with that. So I kind of want to put it back in the RIA frame of mind. So if there's RIAs who are like, man, I really need to do more due diligence, and I want to take a note from FactRight and take a note from your book. So what I want to know from you, what would be like 3 core questions or core fundamentals that they should be digging into when they are evaluating a sponsor or a fund, whichever you'd like to touch on, or both, that you think are critical?
I think one of the biggest areas is really digging through and thinking through the prior performance track record of a manager. And oftentimes we find that you really learn the most about a manager when everyone wants to see, nice big numbers in prior performance returns. I think honestly, you can find and learn more about managers when you have some of the more challenging deals. Let's say if you had 20 previous deals, yeah, and most of them look like they're achieving kind of market returns. It can be difficult to really glean out whether or not there's any sort of like alpha or skill that the manager has, or they've mainly been riding a broader market dynamic in there. One thing that we always look at is like what's gone on in the deals and what's been kind of the narrative related to deals that have had lower returns. And oftentimes there are groups that we've worked with where, that 1% IRR deal actually is the thing that I think is most defining for them, where the managers are like, we made a mistake on X, Y, and Z related to these underwriting assumptions. We worked with our LPs, we got out immediately, and, we live to fight another day. And it's like, I think you can learn a lot more about managers through some of the more challenging times, or how they were working through some of the deals that didn't quite go to plan to help salvage returns for investors. And I think that's the part where it really you can get a sense for the character and the kind of people that you're working with. Did they communicate effectively through areas where they were having challenging times? And that to me really always sticks out, because everyone always wants to talk about what's performed well. People most often don't want to talk about what hasn't gone to plan, but I think you can learn a lot more through that side of things. The other area that I would always look at is how willing is a sponsor to discuss any sort of conflicts of interest and how they've what considerations and what kind of information they provided related to any sort of conflicts of interest if there were affiliated transactions, what kind of support package they have related to that. And I think that is always an area that we're looking to double click on, is to understand any sort of policies and procedures, whether or not they were actually adhered to. I mean, oftentimes we see wonderful, procedure documents, and then when it comes down to the nitty gritty, the actual events that took place maybe don't conform to that. Let's just say that. So that's an area where I think it's also important to really double click. And then similarly, I think it really comes back to just financial analysis of the sponsor. I mean, there's no way around it. Are you gaining a complete understanding of what the operations of this sponsoring entity are? And that has become a much more difficult area that we spend an incredible amount of time focusing on at FactRight. And part of that is, some of the principles of GAAP with consolidation of control entities and variable interest entities. This becomes a much more nuanced discussion than, may have been the case 10 years ago. And I think oftentimes when you look through consolidated financials of a sponsor, especially if they're in the real estate space, this can get very convoluted very fast. What we're looking to do is, in most instances, is disaggregate those financial statements to really get to the core asset management business of the sponsor, not necessarily, the distorting effects of what this consolidated real estate and, the attendant depreciation on that real estate, how that distorts the actual like true health of the sponsoring entity. And I think you can get very quickly a sense of the financial acumen and sophistication of the personnel working at a sponsor when you're discussing through those matters, and also how they think through some of those matters. Because I don't think all the groups that we're working with, and plenty that are fantastic as far as their real estate performance, I don't think they have necessarily the sophistication to kind of analyze their own business, the way that we would like to disaggregate it to get a sense of their actual asset management capabilities, if that makes sense.
My last question for you is, you have, RIAs listening. We have, obviously, there's going to be broker dealers and the clients, but for an RIA who is interested in working with FactRight, what would be the best way? When should they reach out? Like, what's the appropriate time, or is there one? Is there like a trigger? And then two, what's the best way to reach you all?
Yeah, absolutely. And I would say, if you are a broker dealer or an RIA or a family office or, an insurance company or a defined benefit pension system, we're more than happy to, share our research with you. And a real high level, this is third party due diligence. It is the best way to think about it is our core FactRight business is sell side research. We are compensated directly by the sponsors that we're working with. So there is an inherent conflict of interest in there. That said, this research is then made available free of charge to the wealth management firm or pension system. And I would encourage any of these folks to go to FactRight Report Center to request access. Also go to factright.com, see some of the things that we're doing, and also reach out to attend one of our events in the future. We'd be happy to host any of these folks that are looking to really get dialed into more of the alternative investment world in there. One thing I would note as far as that conflict of interest too, given that FactRight's core business as sell-side research, we are receiving compensation from sponsors. There have been over the years, we retain control of the substance of our report. We will provide that draft for factual review to the sponsor, but we will omit our material strengths and conclusions that we're looking to discuss with our clients. Now, all of those conclusions are referenced in the body of the report. And frankly, we retain control over the substance of our report. And if we can't come to an agreement with the manager about, how we're depicting things or things like that, which does happen, we don't need to work with those managers as well. And it does happen on occasion that, we can't come to a reasonable fact-based assessment of, XYZ matter. And, we don't work with some of those managers, or we can't, kind of get the information that we need to really complete a report in a timely fashion. So in general, yes, there are conflicts of interest there, but we do know that our only currency is the credibility that we have with broker dealers, RIAs, and wealth managers. We take that we don't take ourselves seriously, but we take that very seriously. We understand what's at stake for all of these financial firms that are relying on our research. And we definitely understand those matters. And it's our primary focus is to identify material risks and concerns for wealth managers that are looking to get in the alternative investment industry.
Fantastic. Well, Jake, I will not take up any more of your time, but thank you so much for joining Wealth Unfiltered. And to all of our listeners, thank you again for tuning in.
Yeah, absolutely. Always a pleasure. Thanks, Samantha.
Once an advisor has done due diligence and has selected a sponsor they trust, the next step in the process is to fund the allocation. Most clients have more capital available than they realize, and often it's sitting in places the advisors never thought to look. Next week, I sit down with Ramez Fakuri, the vice president of IRA Club. He walks us through the self-directed retirement account playbook for private real estate.